As the broader financial markets are currently closed for the weekend, the closing price for Nuburu Inc., trading under the ticker symbol BURU on the NYSE American exchange, stands at precisely $0.0727 per share as of the final closing bell on Friday, July 17, 2026 at 4 p.m. Eastern Time. This price represents a steep intraday drop of approximately 39% from its opening level of 12 cents. Right off the bat, we are witnessing an extraordinary corporate paradox that defies regular market mechanics. On the exact same day that this stock plummeted past the critical 10-cent threshold and triggered immediate delisting proceedings from the NYSE American exchange, management successfully finalized a massive $38 million public offering priced at more than double its ultimate closing level. This creates a massive curiosity loop for anyone analyzing the situation. Usually, when a microcap company faces forced eviction from a regulated stock exchange, it signals a complete evaporation of institutional capital and investor trust. Yet, a sophisticated group of family offices and accredited backers stepped in to inject heavy funding at a premium price. This creates a sharp divide between public market perception and private capital positioning that requires a serious look at what is truly happening behind the scenes. To grasp the intense pressure surrounding this asset, you have to look at the trading activity that occurred during the final session of the week. Trading volume exploded to an astonishing 39.4 million shares, which completely eclipses its historical averages and indicates massive distribution and defensive accumulation fighting for control. When regular market participants scroll through their mainstream trading accounts looking at massive megacaps like Tesla stock or Apple stock, they are used to high liquidity backed by stable institutional custody. Small, highly specialized engineering entities do not usually experience this level of extreme volume volatility unless a fundamental restructuring is taking place. People who engage in self-investing or use standard online investment tools often assume that a declining stock chart means a business is entirely finished. The broader retail expectation was that this company would quietly fade into the over-the-counter pink sheets without a fight. The reality is a high-stakes corporate transition that is playing out through intense capital restructuring, high-volume options dynamics, and rapid balance sheet reorganization. Let us look closely at the architecture of the $38 million cash injection that closed on July 17th. This was a best efforts public offering consisting of over 244 million units, where each unit comprised a share of common stock or a pre-funded warrant paired with Series B preferred shares. The combined public offering price was established at 15.55 cents per unit, representing a premium of roughly 30% relative to the market valuation just days prior. The transaction was anchored by a prominent New York-based single-family office, along with several accredited wealth management groups. For an investor managing an individual brokerage account or using standard investing sites to build long-term holdings, this structure seems incredibly complex compared to buying basic Fidelity ETFs or allocating capital into automated choices like Schwab Intelligent Portfolios. The reason institutional participants accept these complex arrangements is the massive potential upside if the company manages to wipe out its toxic debt and secure its pending defense acquisitions. Retail traders executing transactions through the Robinhood app or using automated platforms like a SoFi robo-advisor generally see the raw equity value collapsing, while professional syndicates are focused on the structured instruments that protect their downside while positioning them for massive future equity conversions. The immediate operational threat facing management is the official notice received from the exchange staff indicating non-compliance with Section 1003 of the NYSE American Company Guide. Because the shares dipped below the 10-cent floor during the regular session, the exchange initiated formal delisting proceedings. The corporate expectation among casual short sellers was an immediate surrender to the pink sheets, which usually causes a permanent collapse in institutional participation. The operational reality is that management has already announced its intention to appeal this decision before the listing qualifications panel. To regain compliance, the company is preparing to execute a reverse stock split, an action that has already received formal approval from its voting stockholders. When you monitor these events on advanced platforms like the Interactive Brokers platform, you see that a reverse split acts as an artificial pricing reset. It shrinks the floating share count to pump the nominal stock price back above the required threshold. While this doesn't alter the fundamental value of the enterprise, it keeps the ticker listed on a regulated national exchange, preventing the asset from being restricted on main retail platforms like the Robinhood stock trading app or within standard Fidelity investment portfolios. Please take a second right now to comment below how many shares of Nuburu you currently hold, or if you prefer sticking strictly to larger large-cap alternatives. Understanding this company requires looking past the stock ticker and examining their physical technology. The core business is built around the commercial production of high-power blue industrial lasers. Historically, traditional industrial manufacturing has heavily relied on infrared lasers for cutting, welding, and additive manufacturing. However, infrared light is poorly absorbed by highly reflective non-ferrous metals like copper, aluminum, and gold. The blue laser technology developed by this team possesses an absorption efficiency that is up to 20 times higher than standard infrared options, allowing for much faster, cleaner, and more precise thermal processing. This technological edge is exactly why the company is aggressively attempting to execute a major shift in its business model. They are moving away from being a pure component supplier for industrial manufacturing and transitioning into a dual-use defense and security platform. The $38 million raised is explicitly earmarked to finalize the acquisition of a 70% controlling interest in an Italian defense technology company named Tecne SPA. This acquisition is currently navigating the strict Italian government Golden Power review process, which evaluates foreign investments in critical national security assets. Initial testing results for their collaborative counter-drone laser dazzler systems have shown complete suppression of drone electro-optical sensors at significant operational distances in controlled environments. The underlying goal is to secure a meaningful foothold in the global optical defense market, which is projected to expand dramatically over the next 10 years as unmanned aerial threats increase globally. This strategic pivot helps explain why specialized family offices are willing to inject capital at 15 cents, while retail investors are dumping shares at 7 cents. When individual market participants utilize online investing tools, look for investment help, or read materials provided by Fidelity Wealth Management, they are frequently taught to prioritize historical earnings per share and positive operating cash flow. If you view this asset through that traditional lens, the numbers look incredibly hazardous. The company posted a significant net loss in recent quarters, carrying an accumulated deficit and relying heavily on dilutive financing lines to keep the lights on. The expectation was that the company would run out of capital before its industrial laser business could scale. The reality is management is attempting to completely replace its old industrial business model with high-margin defense contracts that feature structural government backing. For active traders who use comprehensive accounts like Interactive Brokers account or handle active portfolios through SoFi Active Investing, the primary near-term catalyst to watch is the elimination of the company's legacy debt. A substantial portion of the newly acquired $38 million is directed towards redeeming approximately $15.5 million of an outstanding December 2025 debenture and settling over $1 million in other convertible notes. By retiring these obligations, management is attempting to halt the toxic equity line amortizations that have continuously diluted common shareholders and dragged the stock price down over the past year. This structural cleanup is a prerequisite for stabilizing the equity. When people engage in self-investing through a standard individual brokerage, they often overlook the hidden damage caused by convertible debt structures that allow lenders to short the stock and cover their positions with newly issued shares. Wiping out these debentures removes a massive structural headwind that has suppressed the equity regardless of any positive technological developments. Looking forward, there are two distinct scenarios that investors must consider. In the optimistic scenario, the listing panel grants a stay of delisting, the reverse stock split successfully lifts the nominal stock price well above the $1 mark, and the Italian government grants final clearance for the Tecne acquisition. This would allow the company to emerge as a well-capitalized defense contractor with specialized photonic capabilities, making it an intriguing speculative asset for higher risk allocations inside a diversified investment strategy. Conversely, the risk scenario cannot be ignored. If the reverse split fails to sustain institutional interest, or if the integration of the defense asset experiences severe regulatory delays, the company could face persistent operational